Welcome to the Deep Dive. We're the show engineered to cut through all that information overload
Yep, we take your stack of sources, filter out the noise.
and hand you that crystallized knowledge you need to be, well, truly well-informed.
Uh-huh.
Today, we know exactly what's probably on your mind. Why does the crypto market feel like it's just running in place this summer?
Yeah, treading water a bit.
So we're diving into 5 critical drivers to figure out, is this just a short pause or maybe something more fundamental?
And that feeling, that stagnation you mentioned, that's really the essential tension defining the market right now. It's tricky.
How so?
Well, you've got this deep structural growth happening underneath, right? Layer 2s are expanding like crazy. Institutional access keeps pushing forward.
Relentlessly, it seems.
Exactly. But then, slammed up against that, you have these massive macro liquidity constraints. It's forcing capital to just circulate internally.
Meaning
Any real upward movement is super hard fought.
Yeah.
And often temporary.
Okay, let's unpack this thing. Get specific. Our mission today is to analyze these 5 forces. The macro liquidity situation, a really big regulatory fine, an outrageously bold Bitcoin forecast, a DeFi star that's surging against the trend, and the path forward for institutional XRP. We want to figure out, is the market stuck in recycled mode, or is it actually poised for expansion?
Let's dig in.
All right, let's start with that central puzzle. A recent Wintermute report calls it the recycled liquidity phase.
Yeah, and this is the crucial finding, really. Money is circulating within the crypto ecosystem.
Okay.
But, and this is the key part, new capital just isn't entering. Not in significant amounts anyway.
But wait, didn't we see huge growth earlier? Like ETFs, digital asset treasuries?
They shot up, right, and stablecoins.
We did, and that's what's fascinating. If you only look back a bit, the raw growth figures look phenomenal. Assets in ETFs and digital asset treasuries, they jumped massively. Stablecoin issuance doubled.
So tons of activity. Enormous internal activity, yes. But, and here's, to catch all those growth metrics have stalled out in recent months. It demonstrates that just trading internally isn't enough to push prices higher sustainably.
Okay. And Wintermute talks about these 3 crucial channels, pillars of liquidity, they call them.
Exactly. They argue these 3 pillars need to be expanding for us to see real, healthy market growth.
What are they?
So the first pillar is stablecoins. Think of this as showing the risk appetite of crypto-native folks. It's like the base collateral.
Got it. Risk appetite.
Second is ETFs. This is the main doorway for traditional finance, TradFi, to bring in new passive and institutional money.
Right. The on-ramp.
And the third is digital asset treasuries. This is the bridge, really, between traditional assets and on-chain liquidity. Think tokenized funds.
Okay. Stablecoins, ETFs, digital treasuries, and the data shows.
All 3 are pretty much static right now, flatlined.
So here's the core question then. If central banks are actually starting to ease policy, and it's not like there's a global money shortage, why isn't that liquidity flowing into crypto? Where's it going?
It really comes down to competition. Simple as that. The capital isn't just vanishing. It's going to safer, frankly, more attractive havens right now.
Like what?
Well, the main issue is high short-term interest rates, specifically the U.S. SOFR rate. That's the benchmark for overnight bank borrowing. It makes U.S. Treasury bills look incredibly appealing.
The risk-free rate.
Precisely. Why would you expose yourself to crypto's volatility when you can get a guaranteed, pretty high single-digit percentage yield on a T-bill? It's almost a no-brainer for some capital pools.
So liquidity that could be going into risk assets like crypto
Is instead parking itself in T-bills.
Yeah.
Or it's getting channeled into other hot sectors, AI, prediction markets, places where the short-term return narrative seems stronger right now.
Okay, so if the faucet for new money is basically turned off and we're just trading amongst ourselves, Wintermute calls this a player versus player market, PvP.
Yeah, PvP.
But hang on, if trading volumes are still healthy, why is that considered a fundamental problem? Isn't internal trading maybe a sign of resilience? People are still active.
That's actually a great challenge to the idea. And yes, trading volumes are healthy. But the problem isn't the volume, it's the quality of the price movement.
What do you mean quality?
When you're stuck in a PvP market, overall growth is stagnant. Volatility tends to be driven less by, say, sustained buying pressure from new entrants, and more by things like liquidation cascades.
Whales moving money around, taking each other out.
Exactly. It's money shifting from one big player to another. It's kind of like watching 2 wrestlers grapple in a bathtub full of capital.
Yeah.
Until someone turns the faucet back on, the water level, the price isn't going to rise sustainably.
Okay, that image works. So the key takeaway for you, the listener, is this. Until we see a real directional rebound in stablecoin minting, new ETF creation, or the expansion of digital treasuries.
Those three pillars we talked about.
Yeah, until those start moving up again, we should probably expect price action to stay pretty choppy, maybe directionless.
It seems to be the consensus, yeah.
All right. Now, speaking of caution, let's shift gears completely. Regulatory enforcement. A really critical event just sent a powerful message about compliance.
Oh, yeah.
Coinbase Europe Limited, they just settled with the Central Bank of Ireland for a massive fine. $21.5 million. That's like, what, $24.7 million US?
Wow, okay. That's significant.
And it's the first major enforcement action like this in the Irish crypto sector.
And what was the issue? Was it like deliberate wrongdoing?
Yeah.
Fraud?
Actually, no. The focus wasn't on intentional fraud. It was about a comprehensive technical failure. Seems between 2021 and 2022, Coinbase had significant coding errors in their transaction monitoring system.
The system they need for anti-money laundering, right? As a virtual asset service provider, or VASP.
Exactly. They have to have it to analyze transactions for money laundering and terrorism financing risk, and it wasn't working properly.
Okay, so technical glitches. But how bad were they? Give us a sense of the scale.
The scale was staggering. We're not talking about a small oversight here. There were 3 key coding errors. These caused 5 of their 21 required risk-identifying scenarios to just fail.
5 out of 21, that's a big chunk.
Yeah. For example, one error meant the system wasn't reading special characters and crypto addresses correctly.
Oh, that's exactly the kind of loophole a sophisticated criminal would look for.
Right. And because of these failures, over a 12-month period, more than 30 million transactions, that's like 31% of their European volume, weren't monitored properly.
30 million transactions. How much value are we talking?
Over 176 billion.
Billion with a B. Wow, okay, that is immense. So the system's failure basically left the door open for illicit activity to go undetected for a while.
That seems to be the critical point, yes. The system wasn't flagging high-risk patterns as it should have.
And the follow-up. What happened after they found the errors?
Well, Coinbase apparently fixed the coding errors internally pretty quickly. But the review process, sorting through everything that was missed, that took nearly 3 years.
3 years?
Yeah, and it resulted in over 2,700 suspicious transaction reports, STRs, being filed late to Ireland's Financial Intelligence Unit.
2,700 STRs. And what kind of activity did those cover?
Pretty serious stuff. Reports mentioned suspected money laundering, fraud, drug trafficking, cyber attacks like malware and ransomware, even child sexual exploitation, involving roughly 13 million in total across those reports.
Okay, this is serious. What was the regulator's message in all this?
The deputy governor, Colin Kincaid, was very explicit. He basically said failures in these critical monitoring systems create an opportunity for criminals. They can exploit crypto's specific characteristics, the perceived anonymity and the cross-border nature.
Right. A clear warning shot to the industry about getting compliance right. Was the fine reduced at all?
It was, actually. Initially, it was pegged at 30.6 million, but they got a 30% reduction for cooperation during the investigation. Still a huge number, though.
Definitely. 21.5 million is a serious penalty.
Okay, so that sobering regulatory message really sets a cautious tone, right? Compliance, risk. But now, let's swing to the absolute opposite end of the spectrum.
Oh. Where are we going now?
Pure, unadulterated bullishness. A vision so optimistic it seems to just ignore all this current macro caution we've been talking about.
Okay, I'm intrigued. Who's pushing this view?
Jan 3 founder Samson Mow, he's arguing that the Bitcoin bull run, well, it hasn't even begun.
Hasn't even begun. Wow. What's his reasoning? The price has gone up quite a bit already.
It's a really remarkable piece of market theory he's putting out there, and he's blunt about it. Mow points out that even at current prices, Bitcoin is, just barely outpacing the 3% U.S. inflation rate.
Okay, so relative to inflation, maybe not such a big run yet. Interesting point.
Yeah, he argues that suggests there's still immense upside to come. And he's questioning some fundamental assumptions about market cycles themselves.
Like the halving cycle. He thinks that's irrelevant now.
He's definitely throwing out the conventional wisdom on market timing. He asks, is that traditional 4-year halving cycle even the main driver anymore, especially now that institutional adoption is fundamentally changing the demand side of the equation?
That's the core of his argument then, that demand is changing everything.
Pretty much. He suggests a few possibilities. Maybe we're in a much longer cycle now, perhaps topping out in 2026, or maybe even a decade-long generational run, kind of like how gold behaved after its first ETF launched.
And generational run.
But the most intriguing idea he floats is what he calls the Omega cycle.
The Omega cycle, what's that?
This theory proposes that Bitcoin's price is now driven primarily by global liquidity flows and institutional demand, not really constrained anymore by the minor supply dynamics tied to the halving event itself.
Huh. So price follows the big money flows, not the mining schedule. That connects right back to the liquidity issues we started with, doesn't it?
Exactly. It puts liquidity front and center.
And he still has those really high price targets, right? Like crazy high.
Oh, yeah. He still believes Bitcoin will add another zero. He's sticking to that.
Well, wait a second. Isn't that kind of talk? I mean, ignoring short-term price drops, not worrying about long-time holders selling above $100, isn't that totally at odds with how institutions think? They have quarterly reports,
What?
risk management?
That's a really fair challenge. Is this purely a retail sentiment, maybe?
It does feel very long-term, maybe structurally focused rather than tactical.
He seems to view things like the fear and greed index completely differently, too. It recently hit extreme fear, right?
Yeah, it's pretty low.
Well, Mow argues that for true Bitcoin believers, a low index reading like that is actually extreme greed.
Extreme greed. How does that work?
Because, he says, their primary fear isn't losing fiat value in a price drop. It's losing sats, losing their actual pieces of Bitcoin. They fear not accumulating enough.
Okay. It's an inverted perspective based on accumulating the asset itself, not its dollar value. That's
Right.
a specific mindset.
Definitely a mindset that separates long-term conviction from short-term market noise. And he's putting his money where his mouth is, apparently. Jan 3 recently added 12 BTC to its balance sheet.
Okay, so they're buying the dip based on this outlook. And his target, still $1 million.
He actually raised it recently from
Right.
1 million to 2 million long-term.
Wow. Okay, so maximum conviction there despite the headwinds.
Definitely contrasts sharply with the recycled liquidity concerns. Okay, so we set the stage. Macro headwind, that PvP market, regulatory pressure, a Coinbase buying. Now let's zoom in on a specific project that seems to be defying that PvP environment, at least recently.
Oh yeah, which one?
Aerodrome Finance. The AERO token surged like 10% in 24 hours recently, while most of the market was just kind of flat or down.
Aerodrome. Okay, that's on Base, right? Coinbase is layer 2.
Exactly. It's positioned as not just another DNX, but the central liquidity hub on Base. That's their goal.
The Base itself has been showing some serious strength, hasn't it? Lots of activity there.
Phenomenal underlying strength, yeah. Base recently zipped past Binance Chain in active user metrics, and apparently over 1 million tokens launched on Base just in 2024.
1 million tokens. Wow. That's a huge ecosystem developing.
Massive foundation for a project like Aerodrome to build on. Though Uniswap still handles a big chunk, like 64% of Base trading volume.
Still, Aerodrome's carved out a major niche. What's its total value locked? It's TVL.
That's where it gets really impressive. Aerodrome currently holds nearly half of Base's entire TVL. We're talking over $1 billion locked in Aerodrome.
$1 billion.
Yeah.
Okay, that definitely confirms its status as the liquidity leader on that network. That's serious market share.
And its dominance seems to really hinge on its token model. Why is its design apparently better at locking in liquidity compared to just a standard DAX or AMM?
Ah, yeah, this gets into the V-tokenomics, specifically the Vito-Caro model they use. It's pretty clever.
Where did it work?
So users lock up their AERO tokens to create VRO. This VRO gives them power, basically two critical functions: governance and directing rewards.
Directing rewards.
Yeah, the VR holders get to vote on where the network's future token emissions, the rewards, are sent. Which liquidity pools get the incentives?
So they control the inflation.
They control where it goes, yeah.
Yeah.
And crucially, protocols or users who want liquidity in their specific pool will often pay bribes, essentially voting fees, to VR holders to convince them to direct emissions their way.
Oh, okay. So it creates this whole economy around directing liquidity.
Exactly. It creates deep, sticky liquidity because token holders are incentivized financially to hold the governance token, VRO long-term, and actively participate in directing these emissions. It makes Aerodrome kind of like the central bank for base liquidity.
That makes a lot of sense. Strong fundamentals then.
Yeah.
TVL, market share, a clever governance model.
Incredibly strong fundamentals, yes. But, and there's always a but,
It's still fighting that uphill battle, right? The recycled liquidity macro trend we talked about.
Precisely.
Yeah.
It needs that fresh external capital to flow into the broader crypto ecosystem, including Base, for AERO to really break out beyond just its relative strength.
Needs the tide to lift all boats, essentially.
Yeah, or at least for the faucet to turn back on.
Okay. Finally, let's look at the institutional access story. This seems relentless, doesn't it? Even against things like government shutdowns.
It really does. The institutional push just keeps finding ways forward.
And there's actually some good news here for XRP holders. It seems issuers have found a pretty creative workaround to the U.S. government shutdown that was delaying ETF approvals.
Oh, really? How did they manage that? I know the shutdown basically froze a ton of ETF applications, including the XRP spot ones everyone's waiting for. SEC staff capacity just plummeted.
Right. But major firms, Franklin Templeton, Canary Capital, Bitwise, they updated their filings. And they did it in a way that makes them effective automatically, allowing trading to potentially start as early as November.
Automatically effective, so they don't need the SEC staff to manually approve it right now.
They're basically setting an automatic launch timer, bypassing the need for that immediate staff-intensive SEC sign-off. And apparently there's precedent for this.
Okay. How so?
The recently approved Solana spot ETFs, they apparently use this exact same mechanism. Their updated filings let them go live without waiting for that direct individual green light from the SEC during the staffing crunch.
That's pretty clever. A masterful move, really, to make sure bureaucratic gridlock doesn't completely halt the institutional adoption train.
And the significance here, especially for XRP, after Ripple Labs fought that legal battle for, 5 years? It feels huge.
Oh, absolutely. Nate Gerasi summed it up well. He suggested the launch of XRP spot ETFs could be like the final nail in the coffin for the old anti-crypto regulators. Strong words.
It really proves the point, doesn't it? If we connect this back to the bigger picture, it just underscores the seeming inevitability of this asset class getting institutionalized.
No doubt. And we already have, 6 XRP ETFs trading now, offering futures or leveraged exposure, like that volatility shares one in XRPI.
Yeah, but the big ones everyone's watching are those pending spot applications, Grayscale wanting to convert its trust, Wisdom Tree, 21 shares. Those are the real potential game changers for access.
The ones that hold actual XRP.
Exactly. So what does this workaround actually do to the approval timeline? Does it mean they launch immediately in November?
Not quite immediate. It accelerates the potential launch.
Yeah.
Even with the workaround filings, the SEC will likely still need some time once the government fully reopens, maybe about 4 weeks or so, just to process everything and confirm the effective dates formally.
Okay, so 4 weeks post-reopening. That puts the most likely window when?
Probably late November to December 2024. That seems to be the target window now.
And what's the market sentiment? Are people betting on this happening?
Highly bullish, actually. Polymarket data, for what it's worth, was showing something like an 99% probability of approval by the end of 2024.
99%. Wow. Okay. So strong conviction there.
Seems so.
All right. We have covered a massive amount of ground today. Felt like a whirlwind.
We definitely touched on some key tensions.
Yeah, we started with that macro conflict, the whole recycled liquidity phase, forcing this PvP market. Then we dove into that sobering multi-million-euro Coinbase compliance fine in Ireland.
A stark reminder of regulatory expectations.
Then we swung completely the other way to Samson Mow's super optimistic Omega cycle idea for Bitcoin's future.
Yeah, some hopium there.
Then we looked at Aerodrome, showing real structural dominance with that $1 billion TVL on Base, even in this market.
A bright spot for sure.
And finally, we saw how XRP ETFs are cleverly navigating the institutional path, finding ways around even a government shutdown.
The institutional march continues.
So the market tactics is just crystal clear, isn't it?
Absolutely. On one side, you've got this relentless gravitational pull of institutionalization, right? Forcing doors open for assets like XRP, driving real structural success on layer 2s like Base with projects like Aerodrome.
The build-out continues.
But on the other side, you've got this fierce resistance from the macro environment. Specifically, those high short-term interest rates making safe haven assets like T-bills just more attractive than taking crypto risk right now.
So here's the final provocative thought for you, the listener, to chew on. Which force do you think wins out first? Is it the gravitational pull of TradFi access finally breaking through? Or will the caution driven by high rates keep things stuck in this PvP market for longer?
What force do you believe finally breaks the dam?
That really is the defining question of the moment. A fascinating challenge to mull over. Until next time, we definitely encourage you to explore these connections further.